Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into Blue Ridge BANKSHARES' latest proxy statement. And let me tell you, there's more than meets the eye in this document. Think boardroom drama, shareholder showdowns, and a peek into how the bigwigs get paid. Let's get started. Blue Ridge BANKSHARES, based in Virginia, is getting ready for its annual shareholder meeting in May. At this meeting, shareholders will vote on some important stuff like who gets to be on the board of directors, whether to get rid of the classified board, and how much the top executives get paid. First up, shareholders will be voting to elect 3 directors to the company's board. These directors will serve for 3 years. The nominees are G. William Beale, Sharon McMullen, and Vance H. Spillman. It's like a popularity contest, but with much higher stakes. One of the biggest items on the agenda is whether to declassify the company's board of directors. Right now, the directors are divided into 3 classes, with each class serving a 3-year term. Think of it like a relay race, where only a third of the team runs each year. If shareholders approve the change, all directors would be elected every year. This would give shareholders more power to hold directors accountable, because if it passes, shareholders can vote for all the directors accountable. Because if it passes, shareholders can vote for all the directors accountable. Because if it passes, shareholders can vote for all the directors accountable. Because if it passes, shareholders can vote for all the directors accountable. Because if it passes, shareholders can vote for all the directors at once, every year. Shareholders also get a chance to weigh in on how much the company's top executives are paid. This is a say-on-pay vote, and it's advisory, meaning the board doesn't have to listen to what shareholders say. The shareholders can also choose how often they have this say, either every 1, 2, or 3 years. Think of this as a way for shareholders to keep an eye on executive pay and make their voices heard. Finally, shareholders will vote to approve the company's choice of Elliott Davis LLC as its independent accounting firm for the year. This is basically a rubber stamp, but it's still an important part of the process. The board of directors is urging shareholders to vote for all the director nominees, for declassifying the board, for the executive pay plan, for voting on executive pay every 3 years, and for ratifying Elliott Davis as the accounting firm. Basically, the board wants shareholders to approve everything. It's important to know who's calling the shots. The board has determined that 12 of its 13 members are independent, meaning they don't have any major ties to the company's management. That's good news for shareholders because it means the board is more likely to act in their best interests. However, G. William Beale is not considered independent due to his role as president and CEO of the company. The document includes a board skills and diversity matrix. This chart summarizes the skills, experience, and demographics of the company's directors. It's interesting because it shows what kind of expertise the company values on its board. Looking at the details of each director nominee, G. William Beale has a long history in banking, while Sharon McMullen brings experience in both banking and financial technology, or fintech. Vance H. Spillman has a background in finance and corporate strategy. There are also existing board members with various areas of expertise. Hunter H. Bost has a lot of expertise in digital assets, fintech, real estate, and investing, while Trevor Montano has experience in corporate finance, accounting, and investment. The board includes people with different demographic backgrounds. This section shows how many shares of the company's stock are owned by each director, executive officer, and major shareholder. Kenneth R. Lehman owns a whopping 30.68% of the company. Castle Creek Capital Partners VIII LP owns 18.48%. Blackburn Capital Master Fund LP owns 7.181, 740%. AB Financial Services Opportunities Master Fund LP owns 7.14%. The fact that a few people and companies own so much of the stock means that their votes carry a lot of weight. Now let's dive into the executive compensation. This is where things get interesting. In 2024, including a salary of $318,618,687,179,000 in a bonus of $279,000. In $2020 dollars in 2023, when he hadn't been CEO for a full year, he made $981,279,000 of $15,000 and made $165,000. The executive vice president and chief financial officer made $651,000 when he hadn't been CEO for a full year. He made $900 and a bonus of $209,200 of $205,657, $786,541 in 2006. Dan Ench and Dean Brown, the chief operations and technology officer, made $642,000 other than chief operations and technology officer. made $675,565 in 7 of 2024, including a salary of $300 and a salary of $365,000, 726. It also lists outstanding equity awards, which are unexercised stock options and unvested restricted stock that the executives have. Here's where it gets interesting. The report includes a pay versus performance section, where they adjust what it looks like the CEO was paid and what it looks like non-CEO execs were paid, then relate it to the bank's performance. For example, for G. William Beale, the summary compensation table total says $1,418,633 to $681,818 $7,418,683 Sev $1,000 more. The average non-CEO actually paid of $681.74 says $7,418 $7,640 average non-CEO named executive officers had compensation actually paid was $1,024. $7,418.83 for 2024, but the compensation actually paid was $1,161,760,000 more. The average non-CEO named executive officers had compensation actually paid of $600 compensation actually. As the numbers show, the company's net income was negative in both 2023 and 2024. This isn't great because it means the company lost money both years. Also, it reports that with a hypothetical $100 investment in the company's shares, shareholders would have cumulative return of 26.36 cents in 2023. This is really important. It means that even though the company lost money both years, also it reports that with a hypothetical $100 investment in the company's shares, shareholders would have cumulative return of 26.36 cents in 2024 and $24 $136.36 cents in 2024 and $24 and dollar of the executive out and for you all to analyze. The company has employment agreements with its top executives, which spell out things like job duties, salary, bonus opportunities, and what happens if they're terminated. For example, if Mr. Beale is terminated without cause or resigns for good reason, he's entitled to receive a monthly payment for a certain period of time, plus other benefits. In 2024, the company conducted private placements of its stock, raising a total of $61, $61, $61, and $6 million. Several directors and major shareholders participated in these placements, buying shares of common and preferred stock. Castle Creek Capital Partners VIII LP has the right to appoint 2 directors to the company's board, while Kenneth R. Lehman has the right to appoint 1 director. One proposal is to get rid of the classified board structure. This would mean that instead of electing only a portion of the board each year, all directors would be elected annually. Shareholders get to vote on whether they approve of how the company is paying its top executives. This vote is advisory, meaning the board doesn't have to listen to what shareholders say. The audit committee is responsible for overseeing the company's financial reporting processes and making sure the financial statements are accurate. The audit committee recommended to the board that the audited financial statements be included in the annual report on Form 10-K for the year ended December 31, 2024 for filing with the SEC. If you want to nominate someone for the board, you have to let the company know within a certain time frame. For the 2026 annual meeting, that deadline is no later than March 22, 2026, and no earlier than February 20, 2026, and no earlier than February 2026 on TIAT. Now, putting it all together, what's the story here? Blue Ridge BANKSHARES is at a crossroads. They're asking shareholders to make some big decisions about the company's governance and executive pay. The vote on declassifying the board could give shareholders more power, while the say on pay vote lets them weigh in on executive compensation. The private placements have brought in on executive compensation. The private placements have brought in much needed capital, but they've also given significant control to a few key investors. On one hand, the company's stock performed well, but with net income being negative, there are questions of financial performance relative to shareholder value, and the executive payouts in relation to the company's performance may not be justified in the eye of the market. Ultimately, Blue Ridge BANKSHARES' direction depends on how shareholders vote at the upcoming annual meeting. Will they embrace change and accountability or stick with the status quo? Thanks for watching Corporate Decoder. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate insights. See you next time.